I think we will start the session. People will come in, so we should start the session.
Sorry, Suhas, uh, you are very faintly being heard.
Acha, is it okay now?
Slightly better. Okay, you continue.
I'll just check up. Yeah. Yes. So we start. Sorry for slight delay. There was some connectivity issue, so we are sorry for the same. Uh, Chairman Amit Patel, Co-Chairman Deepak Shah, Secretary of the Society Mihir Sheikh, all seniors and friends. Good evening. I welcome all of you to this lecture meeting on recent important decisions in indirect tax. I welcome and thank today's speaker, CA Advocate Hiro Rai, for accepting our invitation to speak on BCS virtual platform.
Suhas, just a moment.
Yeah,
Sorry.
yeah.
People are complaining that your voice is very low. Kindly make your speaker on the computer a little, the volume higher.
Okay, I will do it. Yes. Is it better now?
Well, sort of. I mean, I think everyone.
Slightly, I think you speak loudly. Otherwise, if that was not.
Okay. Okay. Sorry for some connectivity issue again. So this is the BCS Direct Tax Committee initiative, for which I thank Chairman Amit Patel, Co-Chairman Deepak Shah, Convener Vishesh Sangoi for their inputs and help. BCS is a voluntary body of chartered accountants which adds value to the professional at large year after the year for last 72 years. It's a long time for a voluntary body to remain relevant like this and maintaining its quality standards and ethical and governance parameters. This year is a year of transformation for the world at large and also for the BCS. All our traditional courses and events were conducted with the help of a technology, and this digital transformation helped us to remain relevant. Rather, this year we could achieve higher scale and reach for our courses with participation from different cities and towns, in certain cases international participation also. It was a real value unlocking for BCS events and its contents. We understand that personal touch, the personal physical presence was not there, but this is what we could do under the conditions prevailing. And coming to the subject of today, this is the beginning of new financial year, and we felt we should update the members on important decisions in direct tax in the last 1 year or so. We had a series of lecture meetings covering recent important decisions in international taxation by CA and Advocate Sunil Motilala on 18th March. Recent important decisions in indirect tax by CA Advocate JK Mittal, which was on 9th April recently. And today we have CA and Advocate Hiro Rai on direct tax decisions. The previous two lecture meetings are available on our YouTube channel in case you have missed it. When we thought of direct tax decisions, CA and Advocate Hiro Rai was our first choice, and he was kind enough to accept our invitation. With this small introduction, I welcome you once again, and may I now request Mihir Seth to briefly introduce Advocate Hiro Rai. Thank you.
Thank you, Suhas. Advocate Hiro Rai is a qualified chartered accountant and associated with BCS since 1987. He is the immediate past president of ITAT Bar Association, Mumbai. He started his practice in the field of direct taxes with Advocate Dinesh Vyas and Advocate VH Patil, and commenced independent practice in the year 1984. Mr. Rai is having an impeccable experience in handling variety of cases pertaining to India's direct tax laws. He has been a regular speaker on various forums, sharing his rich knowledge with the fellow professionals in the area of direct tax laws. As always, honor having you here, Mr. Hiro Rai. The stage is all yours. Thank you.
Thank you, Mihir. President, Mr. Paranjpe, the panelists, seniors in the profession, and friends. Amit, I'd request you, in case I'm not audible enough or the volume is not clear or something, please let me know.
You're
Sure,
audible.
we'll let you know.
Hiro,
All
you're
right.
absolutely clear. Please go
Right.
ahead.
A very good evening to each one of you here. My thanks to the BCA for inviting me over this evening. I may just clarify with reference to the introduction made. 1987 was the year in which I gave my first talk for BCA. In fact, my association with BCA goes still a couple of years before. Coming to the topic, I propose to discuss certain important decisions which have been reported from April last year. I will start with some Supreme Court decisions, then I will come to some High Court decisions, and then I will take up some tribunal decisions. As was just stated, there has been a recent talk on international tax decisions, and therefore I will refrain from dealing with any decision on international tax. Just a few points before I come to the talk proper. One, that we are nobody to criticize or comment upon the correctness or otherwise of the decisions. All I would want to say is that based on our experience and expertise on the subject, we form some kind of a judgment as to how much reliance we would like to place upon a judgment. This is the way I would like to look at things. Also, my experience tells me that it is not enough just to know of a particular decision on a particular point. It makes sense to go into or the reasoning behind the decision. We've all heard of this saying which says that if you give a man a fish, you feed him for a day. But if you teach him how to fish, then you feed him for life. If you understand the logic or reasoning, I think you will be equipping yourself much better and be in a much better position. You will be sharper to apply your mind to subsequent situations which you are faced with, subsequent matters you will deal with. That is why it makes sense to go into the logic and the reasoning of the particular decisions. With these few introductory remarks, let's go to the decisions proper. I'll start with a few Supreme Court decisions. I'll start with a relatively straightforward and simple decision where really not much discussion is required thereafter. 426 ITR, page 289. 426 ITR, page 289, Supreme Court, which is Shri Chaudhary Transport Company versus ITA. This decision deals with several aspects relating to 40A1A, which, as all of you know, relates to disallowance in respect of certain expenditure in respect of which there is a failure to deduct tax. Many of you would be recollecting an argument people used to make relying upon the word payable. The section starts by saying any sum payable in respect of which there has been a default, etc. So the argument that was made was that this disallowance applies only to those items which are still payable. The disallowance, according to them, would not apply to amounts which have already been paid. This argument has now been rejected by the Supreme Court. The logic is, and it says that the expression or the word payable is used in a descriptive manner so as to indicate the types of payments that are covered for the purposes of the disallowance. This does not make reference to whether the payment has been made or not. Therefore, the first aspect of this decision, this argument regarding payable, has been rejected. To my mind, this argument was destined to fail because, frankly speaking, if accepted, it would really render the section quite redundant. This is the first aspect. Next aspect, as you're all aware, 40A1A disallowance was initially a disallowance of 100%. By Finance Number 2 Act 2014, with effect from 1/4/15, this disallowance has been scaled down from 100% to 30%. So the assessee in this case made the argument that this reduced disallowance should apply even for the earlier years, that is, prior to AY 15-16. The Supreme Court has negatived even this argument. It says this was brought in by the Finance Number 2 Act 14 with effect from 1/4/15. It applies from AY 15-16 and cannot apply to earlier years. It clearly lays down and rejects the argument, saying that the principles dealing with curative amendments relating to procedural aspects cannot be applied to the amendment of a substantive provision. So this is a substantive provision according to the Supreme Court. The argument regarding curative amendments, which were applied in the context of 40A1A in other aspects, also 43B, for example, in some aspects, those arguments regarding curative would not apply in this case. This is the next aspect. The final aspect which was dealt with by the Supreme Court in this case was that the facts were that the assessee had entered into an agreement with a cement company whereby the assessee was to transport the goods of that cement company all across India. The assessee did not have the enough trucks of its own, so it also engaged the services of other transport contractors or other transporters. When 40A1A disallowance was made on the assessee in respect of the payments to the other contractors, the assessee made the argument that I am only an intermediary or a facilitator between the company and those other operators. And therefore, there was no liability to deduct tax on me. Rejecting these arguments, the Supreme Court said, the contract was between the assessee and that cement company. There was no privity of contract between the company and the other transporters. It was the responsibility of the assessee to transport those goods. And it is only pursuant to this responsibility that the assessee entered into an understanding or agreements with the other contractors. Mind you, it also said that these contracts obviously need not necessarily be only in writing. So it therefore held that the payments that the assessee made to the other contractors was covered by 194C2, that is payment to subcontractors. And therefore the assessee was liable to deduct tax in respect of the same. Accordingly, the disallowance under 40A1A was upheld. So these three aspects have been decided by the Supreme Court in this case. Really speaking, as I said, rather straightforward decision, really nothing much to say thereafter or to discuss. We come now to a very recent decision of the Supreme Court in 126taxman.com, page 69. DCIT versus Pepsi Foods Limited. This deals with the power of the tribunal to grant stay of demand. As most of you would be aware, 254(2)(a) gives the power to the tribunal to grant stay. Normally, in the first instance, if satisfied, the tribunal grants a stay for 182 days. That can be extended to 365 days on an application by the assessee. But then there is a proviso to this subsection which says that if the order disposing of the appeal is not passed by the tribunal within 365 days, the stay will stand vacated, even if the delay is not attributable to the assessee. This is what the third proviso said. The stay will stand vacated at the end of 365 days, even if the delay in the disposal of the appeal is not attributable to the assessee. It was the constitutional validity of this third proviso which was challenged before the Supreme Court. The Supreme Court says, 1. This third proviso is discriminatory because it makes no distinction between assessees who are at fault and assessees who are not at fault. So the assessee who is not at fault is discriminated against. This was what was accepted by the Supreme Court. It is discriminatory. Further, it goes on to say, it is also arbitrary. Even if the department keeps on taking adjournments, say for instance, and therefore it is the Department of the Revenue which is responsible for the delay, still there would be vacation of stay, which normally always is normally in favor of the assessee. Normally stay is granted always to the assessee. So even if there's a default by the revenue, there's a vacation of stay in favor of the revenue. Therefore, Supreme Court says this is arbitrary, being capricious, irrational, and disproportionate as far as the assessee is concerned. Due to both these reasons, that is arbitrary and discriminatory, it was held that this third proviso violates Article 14 of the Constitution and as it stands is not valid. So this third proviso has been read down by the Supreme Court to say that the stay shall stand vacated at the end of 365 days only if the delay in the disposal of the appeal is attributable to the assessee. So what flows out of this decision? First of all, it is a very important decision which applies to very many cases where stay has been granted, because it is quite often one sees that the matters are not disposed of even after 365 days of the granting of the stay. Now what would happen is, even when 365 days have passed, one would have to go into the reasons as to why the appeal could not be disposed within the period of 365 days. If that delay is attributable to the assessee, only in such cases will that stay be vacated. So you would appreciate from what I've said by now the importance of this decision. Why I have brought out this decision is, apart from its importance in the context of stay, as you all would possibly be knowing, I think in a very little time, the action is going to shift into the challenge of the constitutional validity as regards the faceless tribunal. And some of the arguments which are accepted in this decision are arguments which I expect to be taken when the faceless tribunal is challenged. For instance, one of the arguments which is accepted here is that the remedy would then become illusory. Suppose your stay stands vacated for no fault of yours. What is the point if you succeed after 2 or 3 years? By that time, you may be completely ruined, finished financially. So your remedy of an appeal would possibly become illusory. This has been one of the arguments which is accepted, and this was one of the reasons when even there was no specific provision in the Act empowering the tribunal to grant a stay. Still, the Supreme Court had laid down that it is an incidental and ancillary power to grant stay. Otherwise, your remedy of the appeal might become illusory. Similarly, when you're having a faceless tribunal, it is very possible that in a wide variety of cases, your remedy is really illusory. You cannot decide complicated questions of law and fact merely on the basis of written submissions. So let's see what happens. Most people, I think, are awaiting the notification of the scheme. That's when the action will start, as and when that scheme stands notified. We come to the next 423 ITR 267. Supreme Court, CIT versus Chetak Enterprises Private Limited. This dealt with Section 80IA infrastructure facility. Those assessees which are engaged in infrastructure facilities are eligible for 80IA deduction. In this case, the facts were that there was a partnership firm which entered into an agreement with the state government to construct a road. And of course, after the completion of the construction of that road, it was entitled to collect toll. The construction of the road was completed on 27/3/2000. Note the date, 27/3/2000. And the inauguration was on 1/4/2000. 1/4/2000. On 28/3, that is in between the days, 27/3 and 1/4. On 28/3/2000, the said firm was converted into a company under Part 9 of the Companies Act. For the AY 2002-3, everything happened in the year 2000. For the AY 23, the assessee company claimed the deduction under 80IA. The AO denied the 80IA deduction, saying that 80IA 4, small Roman 1 conditions were not satisfied. So Supreme Court went into those conditions, those two conditions which according to the AO had not been satisfied. One, the first condition in clause A is that it said the requirement of the act was that the enterprise carrying on the infrastructure business should be owned by a company. This was the first requirement which according to the AO was not fulfilled. The enterprise carrying on the infrastructure business should be owned by a company. Supreme Court answers it saying this condition is satisfied. We are looking at AY 23, and prior to AY 23, that is in the year 2000, the firm had converted into a company under Part 9, and the effect of that was that all the assets vested in the company. Therefore, in the AY 2002-3, the condition regarding the ownership by the company was satisfied. So first condition taken care of. Second condition which was there, which also the AO says, the assessee should have entered into an agreement with the state government. Here also Supreme Court says this condition is also satisfied. But the facts in that case are important. Supreme Court has relied on those facts, saying that here the agreement was between the firm and the state government with a clear understanding that as and when the firm gets converted into a company, the name of the company will be recorded and recognized. And this was actually done once the firm was converted into a company. Therefore, they said this condition also of the agreement having been entered into by the assessee with the government, because department said assessee in this case is company, agreement was by the firm. So apart from the facts of that case, an additional argument was also accepted by the Supreme Court, saying that if you see the agreement, it says the firm, which includes its successors and assignees. I'm laying stress on this part because normally we tend to just include certain terms and expressions in agreements, sometimes not following them fully. See the importance of these words. Normally the agreement says, as in this case, it said the firm, which includes its successors that are assigned. Now this important expression came to the aid of the assessee in this case. And Supreme Court therefore said both those conditions were satisfied and the deduction was allowed to the assessee. See, in this era of conversions of firms into companies, mergers, demergers, this decision lays down certain important principles. See, fortunately, many of the sections do contain a saving provision. For instance, 80IA12 itself says that in case there has been a merger or a demerger, as far as the initial period, it will be allowed to the demerged company or the existing company as it first existed. And for the remaining years, it will be allowable to the resulting company or the amalgamated company. So that is fine. Normally, these provisions are there in many of the sections, as in 80IA12. But in this case, those would not apply, because if you carefully see 80IA12, it says when the undertaking of an Indian company is transferred. So you should have been a company first, because it envisages all those other conditions of owned by the company, agreement, etc. So 80IA12 refer to where the undertaking of the Indian company is transferred. So this would not help the assessee in the facts of this particular case, because initially it was not a company itself, it was a firm. That is why ultimately the Supreme Court says yes, it is allowed. I'm trying to lay specific emphasis on this decision. Apart from what it holds, I wanted to draw attention to the importance of what is put down in agreements. As I was earlier mentioning, when we used to study drafting, etc., in college days while doing law, I don't know whether CA course today goes into drafting, etc. But sometimes we never really followed the necessity of certain expressions. Now we realize, as this case demonstrates. So here is a case where we should understand why these terms are inserted in agreements. They come to the use so that even the successors, the assignees, are bound by the terms of the agreement. I'll give you another unfortunate observation, which I think is very relevant to a lot of us. Very often I see grounds drafted to the CIT appeals or grounds drafted before the tribunal saying, on the facts and in the circumstances of the case, the AO was not justified in disallowing so and so. In my respectful submission, this expression is misplaced. These kind of words should not be used. These words have a specific connotation. In fact, if you know, now we have an appeal to the High Court. Earlier, there used to be a reference to the High Court. And either appeal or reference is always only on a substantial question of law or earlier question of law. So normally the question is to be drafted whether on the facts and the circumstances of the case, the tribunal was justified in so holding. This expression connotes on these facts and circumstances of the case, was the tribunal justified in giving a particular decision? Thereby meaning, these are the admitted and agreed final facts. On this, we are requesting the High Court to give its decision. Now, to use this expression in grounds of appeal before CIT appeals and tribunal is erroneous, because very often before the CIT appeals and the tribunal, we are challenging a lot of facts. We are still challenging the facts, and it is the tribunal which is the final fact-finding authority. Therefore, when you say on the facts and circumstances of the case, you're in fact possibly admitting facts, which is not the case when you're challenging facts. So please appreciate the use of these expressions in drafting of ground before CIT appeals and tribunals is not correct. We come next to the Supreme Court decision in 424 ITR, page 1. 424 ITR, page 1. Basir Ahmad Sisodia versus ITO. It's an interesting judgment. A little out of the way. The facts here were that in the assessee's accounts there were certain credits which assessee said represented the sums owed for certain purchases made, that is creditors. But unfortunately, in the course of the assessment proceedings, this claim could not be proved. So the assessing officer sorry. So the assessing officer added these amounts. CIT appeal confirmed. Tribunal confirmed. Even High Court dismissed the appeal. The matter was now before the Supreme Court. Before the Supreme Court, the assessee made an application to bring subsequent events on record. What had happened was that consequent to the additions, there were penalty proceedings initiated. And when that matter came up before the CIT appeal, assessee produced the affidavits of those parties. In a remand proceeding, the AO recorded the statements of 12 out of those 13 parties. He didn't say much against those parties or the assessee in the course of those remand proceedings. Therefore, it happened, that the assessee was successful in establishing the credentials. So the explanation was accepted and the penalty was deleted. Supreme Court holds the penalty proceedings were the outcome of the assessment order. The factual basis on which the addition was made no longer survived. And therefore, the addition was not sustained. Addition was deleted by the Supreme Court. Just appreciate the facts of this case. This can be very helpful, particularly in situations where, due to very many genuine difficulties, often assessees are unable to furnish adequate evidence in the course of the quantum proceedings. It's important that Supreme Court has chosen not to go into the technicalities regarding additional evidence, etc. See, normally what happens, if you have an addition and you have a consequent penalty, if the addition goes, the penalty goes. But this is a reverse situation, where the penalty having been deleted, it was used to say that even the addition ought to be deleted. I'd only like to sound a little note of caution. Here, it is not as if the penalty was deleted, therefore the addition should be deleted. I would not write to read this judgment so broadly, because it is a different set of circumstances which apply to addition on quantum and a different set which applies to the levy of penalty. Different considerations apply. So I would not want to go that far. But in this case, the evidence produced had a bearing on the merits. The evidence produced had a bearing on the merits. And in the remand proceedings, the AO recorded the statements of the parties, did not doubt the identity, and made no adverse comments as regards them. It is therefore the penalty was deleted. So when these facts are such that they have a bearing on the merits of the matter, only then possibly I would feel this decision can be of great use to the assessee. I'll take one more decision of the Supreme Court in 431 ITR, page 1. 431 ITR, page 1. Mavilai Service Cooperative Bank Limited and others versus CIT. This is a decision in the context of ATP. I know ATP may not be relevant to most of us, may not be very greatly applicable to many of us, but this decision lays down certain important principles, particularly regarding interpretation. That is the reason I thought I should take up this particular decision. First proposition laid down by this decision is that it is only the ratio decidendi of a judgment that is binding as a precedent. Only the ratio which is binding as a precedent. While going into this judgment, while reading this judgment, we find that the Supreme Court was considering an earlier judgment of the Supreme Court in Citizen Cooperative Society Limited, and the issue arose as to what part of that decision of the earlier decision was binding as a precedent. That earlier decision in Citizen Cooperative had laid down certain propositions as regards Section ATP. And after laying down those propositions, it finally held that in the case of that assessee, since most of the assessee's business was conducted illegally with nominal members, therefore the deduction under ATP in that case was not allowable. The issue arose, what was the ratio of that earlier Supreme Court decision? And the Supreme Court lays down a very important proposition, and I will quote from the decision of the Supreme Court. I can't put it in a simpler manner or a different manner. It's best to read what the Supreme Court itself says. The statement of the principles of law applicable to the legal problems disclosed by the facts alone is the binding ratio of the case. The judgment based on the combined effect of the statement of the principles of law to the material facts of the case cannot be described as the ratio decidendi of the case. Simply meaning, those propositions which were laid down qua ATP, that was the ratio of the decision. Application of that to the facts of that particular case was not the ratio of the decision. The principles, the legal principles laid down is the ratio of that decision. This is the first proposition. Second, it lays down that a proviso cannot be used to cut down the language of the main enactment where such language is clear, or to exclude by implication what the enactment clearly states. So if the main enactment is clear, then a proviso cannot be used to limit or cut down the clear language of the main enactment, or so as to exclude by implication what is clearly covered by the main enactment. In the context of ATP, ATP 2A1 said that income arising from providing credit facilities to its members is what is deductible under ATP. ATP 4 was a proviso which made proviso to this provision which referred to agricultural societies, etc. We are not concerned with that. It referred to agriculture. So the argument of the department was that to fall under ATP 2A1, that is providing credit facility to its members, this must be only in the course of agriculture. That means to agriculturists. Your members should be agriculturists. Supreme Court says no. In ATP 2A1, it is clear that there is no limitation that it should apply only to agriculturists. ATP 4 is merely a proviso and cannot be made to cut down the language of the main clause 1. Another important proposition laid down by this decision was that ATP is a beneficial provision. We have grown up with this in our heads. ATP is a beneficial provision to promote the growth of the cooperative sector and must therefore be led liberally and reasonably. Liberally and reasonably. And if there is any ambiguity, in favor of the assessee. We have grown up with this principle in mind, though this principle was in somewhat danger in the recent past due to some contrary decisions. But again, the Supreme Court has, in this particular decision, which is a three-judge decision, laid down this proposition that deduction provisions, exemption provisions must be read liberally and reasonably, and if there is an ambiguity, in favor of the assessee. Also, the last point in this decision was ATP 2A1 refers to income arising from granting credit facilities to its members. Even if the assessee is providing credit to non-members, that would not disentitle the assessee from getting the deduction qua its transactions with members. You have to exclude that portion attributable to the non-members, and qua the members, you will be entitled to the deduction. Note, the words do not say solely for the purpose or solely engaged in activities with its members or something to that effect. There was no requirement that the activities must be solely with its members. When there is no such requirement in law, you cannot read it down. And therefore, even if there are some transactions with non-members, does not mean that qua the members, you would not be entitled. You can appreciate the wide applicability of this particular aspect of the matter also. When you're not having the word solely, you could have situations where, say, for example, mutual concerns. You could have transactions with your members which qualify for mutuality. You could have transactions with non-members. So to that extent, you can cull out, the principles of mutuality would apply. I will now come to a few High Court decisions, and I'll start with a few Bombay High Court decisions because I think they are very applicable to us, very important as far as we are concerned. The first decision is 423 ITR 426 Bombay, 423 ITR 426 CESA Goa Limited versus JC. The issue here was whether education cess is allowable as a deduction. The Bombay High Court goes into 40A2, which is a disallowing provision, which said that the disallowance applies to any rate or tax levied, on the profits and gains of business or profession. The court says there is no reference to cess. There's a reference only to rate or tax. There's no reference to cess. In the 1922 Act, Section 10(4) was there, which was the predecessor to 48(2). It specifically referred to cess, rate or tax. 48(2) does not specifically refer to cess, but the earlier provision referred to cess, rate or tax. This is another indication. It further says in the Income Tax Bill of 1961 also, in 40A2 itself, there was a reference to cess, rate or tax. But on the recommendation of the Select Committee, the word cess was deleted, and therefore it did not find place in the final act of 1961. It also relied upon the 1967 circular, which says that cess is not disallowable under Section 48(2). The department tried to argue in great detail with a lot of stress that the word tax includes cess. But even this argument was not accepted by the Bombay High Court. And they therefore held that cess, education cess, which we pay, substantial amount of cess, would be allowable as a deduction. So this decision applies to almost every assessee today. most assessees whose appeals are pending before the tribunal are taking up this issue as an additional ground. And I would suggest all of you who have such issues or who have an appeal pending before the tribunal can and should take up this as an additional ground that the education cess which we pay should be allowable as a deduction. Of course, we have been relying upon the decision of the Supreme Court in NTPC's case 229 ITR for the admission of this additional ground because it's a pure legal issue. Number one, does not require fresh investigation into facts, and therefore we have almost in all cases succeeded in the admission of the ground and getting directions from the tribunal that this education cess is to be allowed as a deduction. In fact, this decision itself says, the Sesagoa decision of the Bombay High Court itself says that this can be taken up for the first time before the CIT appeal and the tribunal. I would also just make a small observation that normally 43B would apply to this provision. Therefore, I would suggest claim a deduction for the amount actually paid by way of education cess during the relevant previous year. Not that you would be allowed a deduction of the cess or the education cess pertaining to that specific assessment year. No, 43B would come into play and only the amount actually paid could pertain to an earlier year also. If it is paid during this year, say along with the essay tax, it can be claimed in the year of actual payment. This is a decision which is being used right, left and center by all of us in the tribunal. We next come to 422 ITR 478. 422 ITR 478 Bombay, Atul Projects India Private Limited versus Union of India. This is a decision in the context of 139.9 defective returns. The facts in this case were that the assessee filed its return. The assessee got a notice under 139.9 saying that there were certain defects in its return. The assessee thereafter filed a return rectifying the defects. Thereafter, a 143.2 notice was issued. This 143.2 notice, if seen with reference to the original return filed, was time barred. But if you consider the date of the return rectifying the defects, this 143.2 notice was in time. Assessee argued that the 143.2 notice is time barred. Bombay High Court upholds this contention, saying that the rectification of the defect relates back to the date of the original return. Therefore, the date of filing the original return is the date of the return and not the date on which the defects are rectified. Therefore, the 143.2 notice, when seen with reference to the date of filing the original return, was held to be time barred. This decision can be helpful in a lot of cases. The facts of this particular case. Loss returns. You are required to file a loss return within the time limit under 139.1. If there's a defect in your loss return and you rectify that, obviously that is likely to be post 139.1 period. This decision, according to me, would come to your aid to say that yes, your loss return is therefore filed in time, and therefore you should not have a problem in the carry forward of that loss. Same applies to Chapter 6A deduction. Chapter 6A deduction also is now conditional upon filing the return within the 139.1 period. There also you could use this decision. Possibly, I'm not saying finally, I still have to apply my mind, though there are a few decisions in the context of, directly in this context, in the context of filing revised returns. So there was an instance I had come across when an assessee had filed a return disclosing a positive income, This was filed within the 139(1) period. Thereafter, there was a revised return, which was, of course, beyond 139(1) time limit. But that return, the SSE having found a mistake, that return was a loss return. So the issue arose whether your loss return can be said to be one filed within the time limit under 139(1). I'm not saying that this decision would apply to the facts of that case. All I'm saying at the moment is that this is a decision which can be used while arguing that case. And I believe there are a few decisions directly on that point also. Next, 430 ITR, page 121. 430 ITR, page 121, Bombay, CISA Sterlite Limited versus CIT. This is a problematic decision in the context of section 263, revision. In this case, the SSE had claimed an exemption under section 10B. The AO called for certain information in relation to that exemption. The SSE filed that information. There was one more communication from the AO raising several queries in respect of that 10B claim. The SSE responded to all these, and then the assessment order was passed in which this 10B claim was allowed. The CIT passed an order under section 263 saying that this is erroneous and prejudicial. AO has not gone into the 10B exemption. The Bombay High Court holds that it is true that the AO called for the information, but that by itself is not sufficient. It is necessary that the AO, this is what it says, it is necessary that the AO actually applies his mind to the information supplied by the SSE. He should consider this info and therefore form an opinion whether the SSE is entitled to the claim. This is what is expected of the AO. Then it says, from the assessment order, we find that there is no discussion whatsoever. Therefore, it holds that there is no consideration whatsoever of the information provided by the SSE for the claim under section 10B. It was therefore a case of no consideration rather than inadequate consideration. And therefore, the revision under section 263 was upheld by the Bombay High Court. It has considered Gabriel's case also, which was the leading Bombay High Court decision on the point. You would now realize how much difficulty this decision is likely to create. It's going to create a major problem. The problem is going to get further compounded now by reference to explanation 2, which says in certain circumstances provided therein, it shall be deemed that the order is erroneous and prejudicial to the revenue. Unfortunately, what has happened in this decision is that several decisions of the Bombay High Court, in the context specifically of 263 and also 147, which have held that when the AO has made an inquiry, the SSE has responded, filed the particulars, it should be taken that the AO has applied his mind, and therefore 263 was not valid. 148 proceedings or 147 proceedings were not valid. Unfortunately, a lot of these decisions have not been considered. So we have a very difficult situation now being created, wherein this latest decision of the Bombay High Court, in the context of revision under 263, is going to create a big problem. Let's see how the situation develops. Let's see whether we are able to get a larger bench in the light of contradictory views of the division benches. But until that happens, at least in Bombay, we will have a substantial problem. We have another decision of the Bombay High Court in 316 CTR 842. 316 CTR 842. Principal CIT versus Mangalore Refinery and Petrochemicals Limited. This was in the context of 234 B and C interest with reference to MAT under section 115JB. In this decision, the facts were that the assessee did not pay advance tax qua book profit following the then decision of the Karnataka High Court in Quality Biscuits Limited, which had then laid down that the provisions of advance tax do not apply to book profit under 115JB. That decision of the Karnataka High Court had thereafter been reversed by the Supreme Court in Rolta's case, holding that advance tax provisions apply even to book profit cases. The issue arose before the Bombay High Court whether, in the facts of that case, were 234B and C interest applicable. Bombay High Court holds that at the time when the advance tax was payable by the SSC, it was the Karnataka High Court which held the field at that point of time, and therefore the SSC was not required to pay advance tax. Even if the Supreme Court reversed the said view, the Bombay High Court holds that was much later, and therefore it held that the tribunal was justified in holding that 234BC interest was not levied. The importance of this decision is, you can appreciate, it can possibly be applied in a wide variety of situations. Co-interest under 234BC. Let's take a simple example. Just now, Bombay High Court, we dealt with education cess is allowable. So, in the unfortunate event that that decision stands reversed, if today I have claimed that education cess is allowable, ultimately I may lose if the Bombay High Court decision is reversed by the Supreme Court. Still, I would be able to argue that on the basis of the Bombay High Court decision, which seems to be the only decision on the field, in fact, there is the Rajasthan High Court also in favor of the SSC. The assessee therefore had a good cause at that point of time to say that advance tax was not payable. So even if I eventually lose on this aspect, I can argue, and possibly successfully, that 234B and C interest qua this portion should not be levied. You can imagine how far this decision can go. I will now deal with a few other High Court decisions. (424) ITR, page 498. 424 ITR, 498 Gujarat. Vodafone SR Gujarat Limited versus ACIT. This dealt with section 80IA5, which, if you can recollect, said that while computing the deduction under 80IA, that particular business of the undertaking is to be treated or considered as the sole source of income, as the only source of income. Therefore, effect of this being that, suppose you had earlier years losses from that same undertaking, and those had been set off against other sources, still because of 80IA5, since the deeming provision is that you have to treat that as if it was the only source, still, though those losses have been set off in earlier years against the other income, for the purpose of computing 80IA deduction, say for the current year, those losses are to be deducted against the income from that undertaking, and it is only on the net amount that you will be entitled. This is what the 80IA5 says. The facts in this case were that there had been a change in the shareholding of that company, and therefore section 79 had kicked in. It had applied, because of which the losses could not be carried forward. The assessee claimed 80IA deduction without setting off these earlier years' losses. AO says no. Based on ATIA 5, you are to reduce these losses while computing the current year's ATIA. So the Gujarat High Court holds that when the losses of the earlier years have already lapsed, they cannot be notionally brought forward and set off against profits of the current year for computing the deduction under Section 80I. They said you cannot invoke ATIA 5 so as to ignore the provisions of Section 79, and therefore it held in favor of the SSE. In fact, I may add another argument. What does ATIA 5 say? All that it says is that it should be considered as the sole head of income or the sole source of income. It does not mean that whatever has already lapsed gets revived. It does not say so. ATIA 5 only said it should be treated as the sole source of income. But that does not mean that what loss has already lapsed is again getting revived. The court also relied upon Gotla's case, which all you know is a very well celebrated decision, which says that if the literal interpretation leads to an absurd result, which should never have been anticipated by the legislature, and if another construction is permissible, that construction should be preferred, which results in equity rather than injustice. I think this decision, though it is in the context of Section 79, can possibly even apply to those cases where the losses have lapsed due to the time period. This is one. Also, maybe the facts of this case are not applicable to a wide number of assessees, but I have taken this decision only to support what I have earlier said, that if you go into the rationale and logic of decisions, they help you in future when you apply your mind to different situations. This is one of those decisions which, if you read this decision, the clarity of thought and the reasoning will really help you. Yet another, according to me, a very far-reaching decision of the Delhi High Court in 316 CTR, page 392. 316 CTR, page 392, Delhi, Sanjay Sawhney versus Principal CIT. This is in the context of Rule 27 of the IT80 rules. Very important. Rule 27 of the IT80 rules says that the respondent, though he may not have appealed, may support the order appealed against on any of the grounds decided against him. I repeat, the respondent, though he may not have appealed, may support the order appealed against on any of the grounds decided against him. We'll come as to how this rule is applied. In the facts of this case, there was a search, and against the assessee, a 153C proceeding was initiated, and certain additions were made. The assessee appealed before the CIT appeal and challenged both the 153C proceedings initiation as also the addition on merits. The 153C issue was decided against the assessee, but on merits, CIT appeal held in favor of the assessee. So since the addition was deleted, the department went and appealed to the tribunal. And as very often happens, unfortunately, assessees don't file cross appeals, assessees don't file cross objections. So when they went to the council at the stage of arguing the appeal, that is the department's appeal, that council raised the argument that we must now avail of Rule 27, we must be permitted to, because I want to support the order of the CIT appeal by raising this issue of the validity of the 153 proceedings. So the tribunal says no. Rule 27 does not apply in such a case. It also made an argument that there is no application in writing seeking the application of Rule 27. For both these reasons, the SSC was not allowed to raise the issue regarding the validity of the 153C proceedings. The Delhi High Court, in a very detailed judgment, holds first that there is no requirement that he should make an application in writing to apply Rule 27. The tribunal was wrong on this point. That's what it says. It also says Rule 27 should not be construed narrowly. It is not right for the department to argue that the assessee is seeking to expand the subject matter of the appeal. According to the department, the subject matter of the appeal was only the deletion of the addition on merits, not the issue regarding 153C validity, and the assessee should not be allowed to expand the subject matter of the appeal. After reading closely Rule 27 and reproducing it, it says that the addition was deleted on merits. By challenging the 153C proceedings, the assessee, if he succeeds, would mean that the additions will not survive. By challenging the 153C proceedings, all that the assessee is saying that the additions will not survive. The result of that would be that the addition will not survive. And this is therefore a case where the assessee is supporting the deletion of those additions by taking the argument regarding 153C, which is specifically what Rule 27 permits. And therefore they say Rule 27 should be applied to this case, and the assessee is allowed to argue regarding its 153C point. That is, the initiation of 153C proceedings was not valid. Mind you, it is correct. If there were an unconnected issue which would not have any result or bearing on the additions, then that cannot be raised in a Rule 27 application. Rule 27 would not apply in that case. For that, the assessee would be required to file either a separate appeal or a cross objection. But Rule 27 would not apply. Rule 27 would apply only here when all you're seeking to do is support the deletion of that addition by the CIT appeal by taking up the argument that 153C proceedings are not valid. I think this decision brings a lot of clarity to Rule 27, which so far has been somewhat unclear. In fact, very often we deal with, this was the case of 153C, very often we deal with 148 matters, where the assessee, though he may have lost on 148 before the CIT appeal, but the CIT appeal having deleted the additional merits, the assessee stays put, is happy that the additional is deleted. But when they come to us, then we say that you should have filed the appeal regarding the 147 proceedings, which the CIT appeal decided against you. Very often that time has lapsed. Then this Rule 27 would help us. Because again, by challenging the reassessment, all that we will be doing is supporting the deletion of those additions, which is precisely the case what Rule 27 permits. So this can be applied even in 148 cases. The next is the decision of the Karnataka High Court, CIT versus Biocon Limited, 430 ITR, page 151. 430 ITR, page 151. This decision deals with the issue whether discount on issue of ESOPs, that is the difference between the offer price and the market price, is allowable as a deduction. I'm sorry, there's a little disturbance. In this case, the department made various arguments. This is not an expenditure. It is capital expenditure. It is contingent expenditure. Rejecting all these arguments, the Karnataka High Court holds: 1. Section 37(1) refers to expenditure laid out or expended. There is no requirement of a payment or an actual outflow of cash. All that is required is that the expenditure should have been incurred, which it has. And therefore, once it is incurred, it is allowed. The primary object of the grant of the ESOPs was not to waste capital, but was to earn profits by securing the consistent services of the employees. Therefore, it goes on to hold that this is not capital in nature. It is for the purposes of the business because you wanted to retain the services of those employees. Therefore, 37(1) applies. It also laid down that it is settled law that if a liability has arisen during the year, it is permissible as a deduction, even though it may have to be quantified and discharged at a later date. This is too well settled a proposition, relying upon Bharat Earth Movers decision Supreme Court and Rotok Controls, also Supreme Court. It held, therefore, that this was not a contingent liability. Therefore, it held that this discount was allowable as a deduction over the period of vesting of the ESOPs. There was a huge debate on the allowability of this discount. And due to conflicting views, a special bench of the tribunal had to be constituted to consider this issue. It is this very special bench decision of the tribunal which came up for consideration before the Karnataka High Court, and it has confirmed the view of the special bench that this is a deduction which is allowable. If I'm not wrong, this seems to be the only High Court decision on the topic. I will only make reference to one small important fact, that in the facts of this case, it was under the scheme that the vesting period was 4 years. But at the end of every year, 25% of the shares were vesting in the employees. And this, according to me, was an important fact which was in the mind of the High Court while allowing this discount over that 4-year period. If possibly the facts are not identical in other cases, the quantum of the allowability may slightly vary, though this decision in principle lays down that the said discount is an allowable deduction. Sorry. The last High Court decision is a decision of the Karnataka High Court. It's an interesting decision in the context of prosecution under Section 276(c)(2). 315 CTR 124 Karnataka. 315 CTR 124 Vyali Communal. It's a long name. Vyali Canal House Building Cooperative Society Limited. This dealt with prosecution under 276(c)(2). Quite a different decision. That's why I thought I'll just make a quick reference to it. In this case, the assessee filed its returns, but the essay tax was not paid. It was paid after some time, belatedly, when coercive steps were taken by the department. Department initiated and the matter proceeded with reference to the prosecution under Section 276(c)(2). The High Court holds 276(c)(2) reads, if a person willfully attempts in any manner whatsoever to evade the payment of any tax, penalty or interest, he shall be punishable, etc. If a person willfully attempts in any manner whatsoever to evade the payment. So it says, what is punishable is an attempt to evade the payment and not the actual evasion. Attempt is done something in the direction of commission of the offense. It must be shown, therefore, that there was a positive act with an intention to evade the payment. That's what it holds. And applying this to the facts of that case, it says, and it holds, the act of filing the returns cannot be construed as an attempt to evade payment. Rather, the submission of the returns would suggest a voluntary declaration of the intention to pay tax. So the very fact that you have filed a return suggests your intention to pay the tax. The delay in payment also therefore cannot be treated as an attempt to evade tax, and therefore the prosecution in that case was held to be illegal. I think these kind of decisions can be very helpful when today prosecutions have become the order of the day. Mind you, the way the criminal courts look at income tax and these prosecution proceedings are a completely different ballgame. What we understand, what we know as income tax, and the way they look at it is completely different. I'll now quickly deal with a few tribunal decisions. Suhas, you may please tell me, do I have another 7-8 minutes?
Yes, yes, sure, sure. Yes, yes, Mr.
All right. I will quickly deal with 3 tribunal decisions. 184 ITD, page 234. Mumbai Tribunal, 184 ITD, page 4. Tata Education and Development Trust versus ACIT. Normally, I'm a very cool person, but when we read decisions like this, my blood boils. That is one reason why I have taken up this decision. This deals with Section 11 exemption. And as you're aware, Section 11 grants an exemption in respect of the income applied to charitable purposes in India. Then there is Section 11(1)(c), which says that if you have applied to charity outside India, then you can be allowed, but only the CBDT has to pass an order directing that that application is not to be included in the total income. That is the requirement of the law. Now, the facts in this case were that the assessee had made certain contributions to or made certain payments to certain foreign universities. It had made an application to the CBDT, and there was no response from the CBDT until the time of passing the assessment order. So the AO very correctly said, this is outside India, you still do not have an order from the CBDT, therefore I'm not allowing you the exemption. Assessee filed an appeal before the CIT appeals. During the pendency of that appeal, the CBDT passed an order saying that yes, we will allow you this, and therefore this amount is to be excluded from your total income. The AO also rectified his assessment order under Section 154. Now, before the CIT appeal, the order is not clear whether the assessee sought to withdraw the appeal. But what the CIT appeal says, he says that what is in appeal before me is the assessment order. And there is nothing wrong with that assessment order. This is what he holds. There's nothing wrong with that assessment order. He also says that that CBDT order is not retrospective because it's come now. So he says it is not retrospective. For both these reasons, he says, therefore, that you are not eligible for this exemption. Said, the tribunal, in a very detailed judgment, holds that once the disallowance of the exemption was deleted by the AO, it was not open to the CIT appeal to still examine the merits of such a disallowance and give his opinion on the same. Further, it said, maybe specifically the CBDT order was not saying that it was retrospective, but it clearly said that this order covers the years which were in appeal. So how can therefore the CIT appeal say that this is not retrospective? It is so clear that they covered the years in the appeal. And the tribunal also says that once the authority which has jurisdiction to pass the order passes it, which was the CBDT in this case, unless that order is set aside by the process of law, it cannot be ignored. How come the CIT appeal can ignore the order of the CBDT in such a manner? And the tribunal puts it very nicely when it says, this CIT appeal seems to be more loyal to the CBDT than the CBDT itself. To say the least, I know I'm using a harsh word, but these kind of decisions are really shameful. Whenever there is talk of the department being taxpayer friendly, the department wanting to minimize litigation, I think this kind of a decision should be shown to them. Okay, this is what your CIT appeals are deciding. In my 4 decades of experience, I have really come across certain really bad orders. And I think this order of the CIT rates pretty high in my list. This is the state when we have physical hearings. God help assessees when we have faceless hearings, or no hearings, faceless appeals. It's sad. Next, 85 ITR Tribunal, page 674. 85 ITR Tribunal, page 674, Mumbai Tribunal, Maria Fernandez versus ITO. This is a decision in the context of section 50C, which almost all of you would be knowing, that the stamp duty value is to be substituted in place of the agreement value. We have had, since the last few years, very many cases where the differences were marginal, say 5%, 10%, 12%. Even prior to 2018, we have succeeded in the cases of such marginal differences, saying that in such cases 50C would not apply. The main argument we were raising and which was being accepted was that the statute itself in chapter 20C, which dealt with acquisition, had laid down that 15% was an acceptable margin. And in those cases, they would not be acquiring the properties. So this was therefore a kind of an acceptance by the statute that there can be differences to this extent, and therefore relying on those arguments, we have succeeded. Came the Finance Act 2018 with effect from 1/4/19, a third proviso was inserted in section 50C, which gave a margin of 5%. Therefore, if your agreement value was 100 and your stamp duty value came up to 105, it says no problem, 50C would not apply. But then this proviso, which was well-intentioned, created problems for people whose differences were more than 5%. Unfortunately, Finance Act 20 comes. With effect from 1/4/21, this 5% is now increased to 10%. So the same margin, 100 and 110. In the facts of this particular decision before the tribunal, the difference was between 5 and 10%. And the issue arose for the year much prior to AY 1920 and all that, prior to the insertion of these provisos. The years were much prior to that. The tribunal in this case holds that this is a beneficial provision to remove hardships, and it is therefore to be construed retrospectively, right from the time when section 50C was enacted. I think it was 2003. So right from the insertion of section 50C, this leeway of 10% should now be available to the assessees. This decision, like I say, 50C is being made applicable in a huge number of cases. This decision will therefore help all those assessees, and it will have a great wide applicability. Therefore, up to 10% cases would stand clearly covered. In cases where it is more than 10%, I think the resort to 50C2 will again have to be taken, where we seek a reference to the DBO and try to contend that the market value is not as much as the stamp duty value. Finance Act 21 has increased this 10% to 20% in case of 43CA. Mind you, I could not see such an amendment in the context of Section 50C. And in any case, 43CA also, the amendment is referable only to a certain period and in respect of certain category of cases. So this kind of 20% limit will not be running across the board. It would apply only to those specific cases referred to in Section 43CA. Last decision which I would like to take is an interesting decision in the context of special audit under 142(2)(a), 183 ITD, page 281. 183 ITD, page 281, Delhi Tribunal, ACIT versus Soul Space Projects Limited. Interesting decision. The facts in this case were that the AO, after obtaining the approval of his CIT, directed a special audit. After some time, the auditor required an extension, so he asked for it, and the CIT granted the same. The assessment was completed, keeping this extended period which was available. As you're aware, Section 153 explanation says that the period from which you were directed to get the audit to the date on which, by which you are required to get the audit completed, this period is to be excluded for considering the limitation period. So the assessee in this case raised an interesting argument. He said 42(2)(a), which requires special audit, requires the permission of the CIT. Yes. Qua an extension, 142(2)(c) proviso, qua the extension is to be given by the AO. In this case, the extension was granted by the CIT and not the AO. Therefore, the assessee said the extension was not valid, and therefore the extended period was not available, and therefore the assessment was held to be time bound. This was the argument of the assessee. This was accepted by the tribunal. 142(2)(c) proviso clearly says that it is only the AO who is to extend the period for the special audit. It says the Act lays down the authorities who are to implement the Act. A power given to a specific authority has to be discharged only by that authority. Officer, even if he is superior to him, cannot validate that action. And therefore, the argument was accepted. The assessment order was held to be time bound. This decision brings to light, according to me, the necessity that we must be aware of and keep abreast of even procedural technicalities of the law. I, for one, myself, do look out for these whenever I'm working on a matter. And mind you, every time we look at these kind of issues, it makes sense to read the Act. My experience tells me, if you read the Act by itself, it is different. But if you read the Act with reference to the facts of a particular case or a particular point in mind, it sometimes can give you a completely different picture. Sometimes the effort or the effect of this exercise can be really sublime and magical. I have really experienced it. Therefore, these procedural kind of irregularities one must always look out for. Whenever there is a sanction required under 151 for reopening proceedings, please do ask for the same. You ask for the same and you will realize so many arguments sometimes can be raised on that. Whenever there is a satisfaction required, say for under Section 153C, whenever there is a satisfaction required, please ask for the satisfaction. I will share with you a recent exercise which have been done. See, there was a search on a company in the course of which the directors' lockers were also searched. So they found certain jewelry. Then 153C proceedings were sought to be initiated against those two directors, and huge additions made. We sought for the satisfaction of the AO for initiating 153C proceedings. On reading the same, we find that they have been initiated on account of the jewelry. Interesting fact is that in the assessments of the individual directors, there has been no addition made for the jewelry. So now we are trying to develop an argument that the issue on which the 153C was initiated, that itself is not added in the assessment made, and therefore is the satisfaction valid when the amount itself is not added. You remember the Jet Airways argument in the context of 148, whether that argument would apply here. These kind of things happen when you get access to these technical requirements. 151 is a classic case. If you read commentaries, you find huge number of decisions in the context of sanction under 151 or approval under section 151, which have been held to be invalid. Therefore, I would request you, wherever these kind of issues are there, please do try and obtain these kind of sanctions approvals. A lot of arguments can be developed based on the same. I think time is ticking by, and I have taxed you quite enough. With this, I'd like to thank you for a very patient hearing. Thank you very much.
Thank you, Mr. Rai. With your permission, can we deal with one or two questions in the Q&A box?
I'm okay, provided they are on the topic.
Yeah. Mr. Hardik, can you just deal with one or two important questions?
Yes, sir. Yes, sir. So I will just take two questions. One was, I think, the most talked about in the Q&A and chat session is the Seshagoa case on education cess. So what I understand that department must have appealed to Supreme Court, right? So one question is the crystal ball gazing. What is your views? How Supreme Court will look at it? Another is just on the basis of this, does someone can revise the return if it is in the time permitted and claim that education cess as a deduction? What is your view on this?
I think if you have time to revise your return, definitely you must claim it. No two ways about it. You must claim it as a deduction. Even if your assessment is completed, take it by way of an additional ground before the CIT appeal. Take it by way of an additional ground before the tribunal, which is what we are doing. So no harm in filing revised return. Even if your assessment is in progress, claim it by virtue of a letter, no harm. You should go all out. As far as the first part of your question, frankly, like I said in my introductory remarks, I would not want to, comment upon the correctness or otherwise of decision of a high court. We are too small to do that. But yes, it's a decision of the Bombay High Court, and today we are succeeding before the tribunal. I really do not know the stake in that matter, whether that will go to the Supreme Court, because today tax effect in Supreme Court is 5 crores.
Okay.
I don't know what will happen there. I don't know whether the amount in that case would exceed that tax limit. So one doesn't know. But yes, of course, one should rely upon, and everybody is relying upon, wholesale we are relying upon. That is.
Okay, sir. Thank you for that. And the other question is this: this observation is by an advocate that all orders staying criminal and civil proceedings will automatically expire within 6 months unless extended for good reason. Says Supreme Court of India in Asian Resurfing of Road Agency versus CBI. What is the fate of Pepsi Foods order in light of the previous three-judge bench pronouncement in Asian Resurfing?
I don't think that will have any impact, because that is a general order extending the time period in all cases. But this was on the legal point regarding 365 days. Maybe 365 days due to the earlier Supreme Court decision might extend it over 365 days. Maybe that's another subject matter. But now when the Supreme Court itself says that 365 days one is to see only whether there's a default on the part of the SSC. That was a limited question before the Supreme Court in Pepsi Foods case. And it has held, therefore, it has in fact read down the third proviso to 254(2).
Right. And I think this is a very simple or practical question on your pointer that people should refrain using the phrase on the facts and circumstances of the case the learned AO erred in. So someone is asking what could be a good alternative. I think that
You
is a
just say the learned AO was not justified in doing so. Don't say on the facts and the circumstances of it. Just say the learned AO was not justified in doing so. That's
I
it.
think many have made these mistakes. I think I can say
No,
that.
I see it every day. I see it
Okay.
every day.
I think with that, I think Suhas, I have taken three questions. We can.
Okay, yeah. Thank you, Hardik. And thank you, Mr. Rai, for dealing with your in-depth analysis of various important decisions and sharing your insight and large experience with all of us. With this, before I request Hardik to propose a very well-deserved vote of thanks, I'll just take your 1 or 2 minutes and I will request CA Ankit to make a presentation of a very brief presentation on YRRC.
Thank you, Suhas, sir. Evening, one and all. I'm functioning committee. BCS Youth every year organizes a residential refresher course since the past 7 years. This year being the 8th year, the 3 days Youth RRC is gonna be held from this Friday to Sunday, that is 16th to 18th. And it will be entirely in a virtual mode, honoring the need of the hour. And we at BCS strongly believe that there are the following distinct features of the event, which would make it worth in the journal, which is we have domestic as well as international speakers to share global insights. The topics cover a wide range of aspects from the life of professionals, networking opportunities like never before on a single advanced platform, learning from best practices across the globe, innovative interactive methods on a virtual mode, which we believe would help the youth in the profession to realign, re-energize and reconnect, which ultimately is the motto of this 8th YRRC. Some of the key topics we have include acing appraisals, wherein we have Mr. Shankar, who's the ex-MD of Tata himself speaking on it. Amongst others, we also have work culture and friendship at workplace. We also have a comic session from our very own theater comedian. So we look forward to majority of the participation from this august audience. Thank you, and over to you.
Yes, and even if it is YRRC, it is open for all. Because of the public demand, we have made it open to all. So others can also surely join it. With this, may I request Hardik to give vote of thanks, please?
To be very frank, I will start with this. For me, this is not the first time I'm hearing on you on this topic. I remember good old days when in person at IMC, I used to come, all the way, and just to make sure that I have the seat before, you start speaking. It was that, bigger lecture on the important judicial decisions. And as you rightly said, you started from, 80s, 85, 87. It's been your contribution to the profession and to people at large, like professionals like us, and your guidance, which has helped us over the years to correct our anomalies, at the same time to give that little insights which you give when you dissect any decision, or when you give your views of how a decision has transpired, and some insights which can help you, like this on the facts and circumstances, right? Small things, but they go a long way in grooming the charter accountants and professionals at large. On the BCS behalf of BCS and everyone who has attended this webinar, we like to toast a hearty vote of thanks with a virtual applause. Thank you, sir. We expect this in future also. Hope so in person. But yeah, thanks a lot for sharing your time and your valuable advice in this session. Thank you, sir. Thank you. Thank you.
Thank you so much. Thank you so much. Thank you, Deepak Bhai.
Thank you.
Thank you. Thank you, Hiro sir.
Thank you.
Good night.